Folks, we've got Oliver L. Velez, speaker at the First Traders Expo, and is one of the most watched money show experts, international best-selling author, world-renowned trader, entrepreneur, and is one of the world's most respected and celebrated traders of all time. In 1999, Dow Jones dubbed him the Messiah of trading. Today, Mr. Velez continues to be defined as one of the most influential leaders of his generation, building on his unmatched track record as the only individual invited back as a keynote speaker 3 times over the last several decades. His legacy of stardom extends beyond the trading world. There may be many opportunities presented to you, but this one will be conducted by one of the top trading minds of all time. Oliver, thanks for being here this afternoon. The
Thank you.
floor is yours.
Fantastic. Thank you. Thank you once again. Thanks for having me. Thanks to all of you at the Money Show. Thank you for my supporters. Thank you for our watchers. Thank you for those who are dedicated to the Money Show organization, which has been a real powerhouse and an influential force and voice in the industry for decades, all the way back to the very beginning. So I want to thank you for being here. Today, I wanted to talk to you about something that I think is extraordinarily fitting in today's market environment. I don't think that anyone who is present today is unaware of the fact that we're living in unprecedented times right now. We're living in times that has brought about a level of volatility in all financial markets worldwide that most people alive today have never experienced. Maybe unless you've been somewhat involved in the cryptocurrency market during the early days and even not so early days. But for the most part, this level of volatility has shocked the world recently. And there is actually no professional who's really experienced what the markets are doing today from a macro perspective. And this has brought about a level of uncertainty that has rocked financial markets worldwide in ways that they have not been rocked before. And what I mean by that is that we're now experiencing an environment where every single asset class, for the most part, is experiencing excessive volatility at the same time. And there is an implosion, if you will, for lack of a better term, across the vast majority of market classes at the same time. This is unprecedented because largely the same time or everything bubble burst is extraordinarily rare, if completely, entirely unique. As an example, a lot of times when stocks are imploding, a flight to safety moves money to bonds, but this is not the case in this scenario. We've got bonds collapsing along with stocks. And so traditionally, that 60-40 split that has been promoted for the past 40 years, where you put 60% in stocks and you balance out the slightly more aggressive, volatile nature of the equity markets out with 40% of your assets in bonds, because when stocks are not doing well, bonds will tend to enjoy the flight away from stocks into the greater safety of bonds, balancing out your portfolio. This has worked for the past 40 years until now. So we're living in unprecedented times where even the flight to safety, there is no flight to safety. So we're living in an environment where cash continues to be trash. You're yielding virtually nothing. Your bonds are no longer a safety haven. They're collapsing along with stocks. So money's coming out of stocks, not going into bonds. Money's coming out of bonds, not going into, having to go into cash. But cash is a problem because cash was a problem before inflationary pressures. Inflationary pressures today are actually making cash even less desirable, or just as horrible as basically keeping your money in the stock market, which is always traditionally been considered higher risk than stocks. And so there's nowhere to hide. There's nowhere to go. And of course, if you put what I consider to be the market's maybe 12th asset class or the market's next asset class, Bitcoin, then we go to a whole other level of volatility. So what do we do in these extraordinarily volatile times? This is why I decided to talk to you today about not only dollar cost averaging techniques, but advanced dollar cost averaging techniques, because this is the number one tool that you pull out of your arsenal when things go berserk. This is the number one tool that you pull out of your tool bag when your assets start to become excessively volatile. We're going to talk about that today. Now, I'm going to sacrifice all of the talk about who I am. You can do research on that. I want to delve as much as I possibly can into the content today. But I do want you to know that I will be speaking tomorrow. I think it's 10 minutes or so before this time, but you can check that out on moneyshow.com. I will be speaking on how to manage your trades like a pro. Today, we're not necessarily going to talk about trades as much as we're going to talk about the investing approach when things get volatile. Tomorrow, we'll talk trading and how your short-term oriented trade should be managed like a pro. And what I will say about that very quickly is that true mastery is in the management, not in the entries, not in the exits, but what happens in between. And we'll be talking about that tomorrow. All right, so this is who I am, guys. You can do whatever research you like to basically, if you're unfamiliar with who I am, to find out, you know, my long journey in this industry, starting all the way back in the 1980s up until now. These are my 5 books. And I do want you to follow me, guys. I have 3 very active YouTube channels in English, Spanish, and Portuguese. Every single day, a piece of content that helps you elevate the way you look at markets and hopefully the way you play markets. Follow me on Instagram and Facebook. Everywhere you go, I am OL Velez 007. Just make sure there are no dots, dashes, or funny business. There are a lot of fake accounts out there. Be careful, guys. I want you safe. OL Velez 007, not OL Velez 007 or a dash or a period or slash. That is it. Okay? OL Velez 007. All right, let's talk about where DCA comes from. There is this raging argument that has been going on for years, and it's still going on today, unbelievably so, about whether or not lump sum investing or playing the market is better or worse than dollar cost averaging. And lump sum is simply the form of investing where you have this large amount of money, or you have this amount of money that you need to deploy. You don't want it in cash anymore. You need it to deploy it in some form or fashion. Do you just take your lump sum and put it all in? Now, there are some that believe that that is the appropriate course of action. And then there's the other camp. There's the dollar cost averaging camp, more commonly known as the DCA camp, dollar cost averaging camp. This camp believes that you should never put everything at risk at one point in time, and that you should take whatever you have and gradually deploy it into the markets. All right. Even if you're going to be investing periodically, the lump sum group feels that once you have cash or once you have something, just put it all in. Don't worry about gradually easing the amount of money in. The DCAers believe that you should take whatever you have, break it up into equal amounts, and deploy it into your asset or the market. Let's talk about, I believe, for one, that while over time the statistics actually don't overly favor one or the other, believe it or not, over long periods of time, there is an argument to be said about lump sum investing, and there's an argument to be supported for dollar cost averaging. So this is why the argument has been raging for so long, because everyone can come up with statistical models that show that each one is better. They're so close over time. But I believe that dollar cost averaging is the superior approach to the play for a variety of reasons, not necessarily for the numbers that ultimately result after a 10 or 20 or 30-year period. It's more peace of mind. It's more about the consistency versus the sporadic nature of lump sum. So I believe there's a premium to be placed, an extra value to be placed on peace of mind and on consistency instead of a sporadic approach to the market. And those things, I think, while you can't put a specific dollar amount on them, I think that from an overall point of view, they do benefit the trader a little bit better, or the market player. So what is DCAing very quickly? Let's look at a definition from Investopedia. And very quickly, guys, dollar cost averaging is simply stated by Investopedia as an investment strategy in which an investor divides up a total amount, as we just discussed, across a period, to be invested across a periodic purchases of an asset with the idea of reducing the volatility. Now, the traditional dollar cost averaging is to take your money, divide it into a predetermined number of pieces, like 4, let's say, divide it into quarters, and deploy 1 quarter at a time at an equal interval. So if that's 1 quarter of my money deployed in a stock for each year, on the first of the year, I'm going to take a quarter and put it in this year on the first trading day of January. The next January, I'm going to put the second quarter in. The next January, I'm going to put the third quarter in. And the final January, I'm going to put the final quarter in. Now, that interval can be any interval, guys. It can be a year, it can be a month, it can be a quarter, it can be a week, it can be a day, it can be hourly. I know people who deploy capital hourly, and I know certain systems that deploy capital by the few seconds. This is what you would call algorithmic trading systems, where an algorithmic trade or an algorithmic programmatic trading would be deployed by an institution that says, look, we want $2 million into this stock by the end of the week. We're going to put it into an algorithm that buys a certain amount of dollars every minute and a half until we evenly deploy that $2 million over a certain period of time. And so dollar cost averaging can be as small as a few seconds to minutes and as big as once a year. All right. So that's very important to understand. Now, what are the main benefits of dollar cost averaging? Now, I know for some of you, this is going to be basic, but listen, I need to go over the basic components of dollar cost averaging. And then what I want to do is take you to my style of dollar cost averaging, which I call dollar cost averaging on steroids. Okay. So listen, the main benefits of the regular plain vanilla dollar cost averaging is simple. It reduces price risk. Now, this reduces the one price risk scenario. This is the #1 argument for dollar cost averaging advocates. They believe, and I believe somewhat as well, that you do not want to have all of your money risks at one single price. This is called price risk. All right. So all of your money has a break-even point at one specific price. And it's not spread over a variety of different prices. In my view, when you spread your money out over a variety of number of prices, you slightly increase the odds of being right. So it's almost like if you had 4 bullseyes on a dartboard, the odds go up that you hit one of the 4 bullseyes versus I've got 1 bullseye to hit. So finding 1 needle in the haystack is lower odds than finding 4 needles in the haystack. They both might be difficult, but one you quite obviously is better better than the other. And so I agree with the DCAers here, where I don't want your capital or my capital deployed at one price and hope that that one price is the right one. All right. So this reduces price risk, one price risk. Okay. It also spreads your capital across time. Now, this is a very important concept that I think a lot of market participants miss. Price is the vertical axis and time is the horizontal axis, and you want consideration on both axes. So if you're just worried about price but not time, you've got 50% of the equation of proper market play under your belt, and the other 50% is missing. There has to be some consideration for time. And so when you dollar cost averaging, you are dollar cost averaging on the vertical axis, a variety of different prices, but you're also spreading out those entries over time. And so you're taking care of the vertical axis as well as the horizontal axis, and price in the universe equates to space. Time is time, and space and time, if you know this scientific fact, space and time are equal. And so when you apply equal importance to space, all right, which is price, and time, all right, you've got the whole enchilada covered to a certain extent. So dollar cost averaging handles both of the axes. Now, dollar cost averaging also reduces the need to time the market. So it doesn't eliminate the need for timing the market, but it does reduce it quite dramatically. And some hardcore DCers say you don't even have to worry about time. Now, I'm going to add to this component in particular, we're going to add a time component, because while it reduces the ability or the need to time the market, I'm going to bring that need back when we go to the dollar cost averaging version, this on steroids version. Okay. So, but the regular DCA does reduce the need to time the market. Also, it reduces the effective volatility. This, in my opinion, is the main benefit of dollar cost averaging, that it is the scalpel, if you will, that sort of cuts the negative component out of volatility and turns volatility, the volatility of an asset, into your friend. So while the vast majority of people are afraid of volatility, you welcome volatility when you're deploying a dollar cost averaging plan. The volatility statistically over time, in most cases, nothing's ever 100% of the case, but most cases works out to your benefit. All right. Now, the last main benefit to dollar cost averaging, in my opinion, is that it utilizes the power of consistency. So in my view, guys, being consistent is far more than having the right timing. And even picking I can't say not pick, got to pick the right thing. That's for sure. But a lot of people put an overemphasis on timing versus just consistency. You could be the worst timer over the past 10 years. I'm going to show you this. You could be the worst timer over the past 10 years and still have made a fortune. All right. It wasn't necessary as much to be a great timer as it was to just have a consistent allocation to this asset or asset class. And so consistency always over time trumps timing. And as we know, most people can't time properly anyway. So the only thing they really have that is statistically workable is consistency. But everyone sort of, or a lot of people drop this notion of consistency and just try to time the market. And this is what contributes to a great many problems in marketplace. So let's look at some examples here. I'm going to show you the proof of dollar cost averaging. So here we're looking at, I just grabbed this right before coming online, guys. I grabbed this is a monthly chart of Apple. We're going back all the way to 2012. Okay, so we're going back 10 years. We're in 2022. This is going back to 2012, right? All right, 10 years. Now, the arrows show us where we have a dollar cost averaging plan of $1,000 invested on the first of every single year. So over a 12-year period, all right? So yeah, we're talking about 12 arrows here. Over a 12 investment entry period, all right? We deployed $1,000 at the beginning of every single year, all right, for a total invested amount of $12,000. This is using Apple. This is no regard for where the price was. This is no regard for timing. It was just like, look, on my watch, I just got an alert on my iPhone, on my smartwatch. It's time to deploy 1,000. I don't care what the news says. I don't care what's going on in the world. I don't care what new iPhone or products Apple's coming out with. I'm just going to buy on the first month of every single year, 1,000. Now, if we did this, this is the result. Out of 11, so there are 11 arrows here. Sorry. Is there 11? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, 11. That should be 11,000. I'm so sorry. I actually calculated as 12,000, but that's wrong. All right. So we really did 11,000. I did it as 12. I did the numbers at 12,000. I apologize about that. So the number's going to be off here a little bit, but look, 11 purchases for 365.8 shares. So each January, 1,000 would have bought on the first year 68.4 shares, on the second year 58.6 shares, and so forth and so on. And notice that as Apple is gaining momentum to the upside, that 1,000 actually is purchasing fewer and fewer shares as we go along in the uptrend of Apple. All right. So the result is 49,000. These numbers might be off because I got the number of dollars invested wrong, but you get the point. $49,000, $511,511 from an $11,000 investment. I know I have 12 here. This number's off, but you get the point. If it were 12,000 invested, it would be a 313% gain. All right. On the accumulation of those 365.8 shares of Apple. Now, that's not bad over a 10, 11 year time frame. But if we were to take something like Bitcoin, all right, much more volatile asset, right? And we do the same thing. So I have here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11, that should be 11,000 invested. I did the numbers based on 12. All right. So let's assume that we put a little bit more than a $1,000 into 1,112th of 1,112th into each one of the buys to get us 12,000 if you want to rock with the number that I have. But so 12,000 or 11,000 invested totally every single year, 1,000 or 1,000 and a little bit, every single January, boom, without regard for what's being said, what's in the news, what's going on in the world, whether there's war, whether there's economic boom or recession, whatever the price is, no technicals, no thinking, January, boom, 1,000 or 1,000 a little bit. All right. This is your result. All right. First year, you accumulated 289 Bitcoin for $1,000. Second year, 75.5. And as you can see, like Apple, as the progression happened over the past 11 years or so, your 1,000 bought increasingly fewer and fewer Bitcoin, all the way down into fractions of a Bitcoin. All right. The total amount, now I did this number based on 12,000 instead of 11, so the numbers are actually bigger, but this $11,000 really produced $7,508,222 for based on 12,000, a $62,000 gain. So we know that this number is bigger if you use 11,000. So the point is that I want to show that when something becomes extraordinarily volatile, and I'm sure that anyone who's familiar with Bitcoin will say that's one of the most volatile, solid assets the world has right now. It's considered to be an 80 vol asset, whereas that Apple is more of a 20 vol asset, or maybe even less these last 10 years, maybe like a 10 vol asset, 15 vol asset, in Bitcoin's an 80 vol asset. That's the industry term, which basically means that Bitcoin has the potential to drop as much as 80%. Apple has the potential to drop about 15% or so if it's 15 vol. I don't know what the exact number is, but you get the point. And so the more volatile the asset, the more powerful the DCA concept actually statistically works. Not 100% of the time. You've got to make sure you have an asset that you believe in and an asset that does typically rebound. And Apple has historically proven that it rebounds. Bitcoin, although its history is shorter, 13 years, has come back from more than 650% plus declines, which basically should prove that it is an asset that has the ability to come back. It's come back from 70+% declines. So it does have the ability to come back. You need an asset that you know statistically has proven its ability to come back from declines. And you need to find out what the vol of your asset is. So let's assume that Apple is around 20%. And let's assume, we don't even have to assume, Bitcoin, I know, is an 80 vol asset. All right, these two numbers are going to be important when we go to the DCA on steroids. Now, what we're looking at here, guys, is we're looking at the plain vanilla dollar cost averaging style, where you take the same amount and you take the same dollar amount, which never changes, and you take the same interval, which never changes, and you just do it without thought, right? Without consideration for whatever else is happening. That's the plain vanilla. And the numbers are quite impressive, whether you're playing a low volatility asset or a high volatility asset. But let me show you that we can do significantly better than this. We can turn these numbers into 3 to 4 times the amounts that you see here with my dollar cost averaging on steroids approach. So here we go. DCA on steroids. I hope you're ready. Let's do it. All right. Now, in order to do that, what we're going to do is we're going to use an asset's declines. You see, in the regular dollar cost averaging approach, there is no regard for whether or not the stock is going up or the stock is going down. But we're going to use the declines in the asset to dollar cost average. Okay. We're going to kind of draw back on the moves up. So we're going to use dollar cost averaging when the world is against the asset, when the market is not performing well. We're going to start our dollar cost averaging plan when maybe the economy is soft, or the asset has some trouble, or there's some negative news in the industry, or whatever the reason doesn't matter. As long as you have an asset that has proven its ability to come back from all of its problems multiple times, that's all you need. Okay. And so we're going to continue to use Apple as an example and Bitcoin as an example. Now, for an Apple, the numbers that we're going to use for declines are 20 to 60% declines. Now, Apple, I can't remember the last time Apple had a 60% decline. I lived through a few of them, but I can't remember. It's been a long time ago. But we're still going to use 20 to 60%. So the zone of 20 to 60% on Apple will begin our dollar cost averaging zone. Now, what I'm showing you on this slide is a red bar, which is signifying the asset dropping. All right. If I wanted to signify it rising, I'd show you a green column, but this is a red column. So Apple's declining. When it starts to break, right? So let's say when Apple starts to break below 20% down from a peak, that's when we can start dollar cost averaging. All right. So we start dollar cost averaging 22% down. All right. And then we're going to dollar cost average I actually do 2, either every third down, or I actually like this, every quarter down. So here's how it's going to work. When you're down about 25%, that's a quarter. Well, no, when you're down 20% in Apple, you can potentially go to 60%. That's what we're saying with this number here, guys. All right. So we're saying we're taking the range of 20% down. All right. So look at this. We're taking the range from 20% to 60%. And we're utilizing this range to begin our dollar cost averaging plan. Now, we're going to take this range and we're going to break this range into 4 pieces. Okay, even pieces. but we start at 20%. So what's the, and the bottom is 60%. So the top is 20% down. So we want to deploy a dollar amount in the top quarter portion. It doesn't matter where in there, just as long as you're in the top portion. So it goes like this: anywhere between 20 and 30%, you're going to deploy, let's say, $1,000. Anywhere between down 30 and 40%, you're going to deploy 2,000. Between 40 and 50, you're going to deploy 3,000. So now remember, this is getting away from the regular DCA, which is I do the same dollar amount. These dollar amounts are changing on the way down. And the regular DCA does the exact same interval. Your interval is not going to be exact this time. You could go from down 20 to down 35 in a week in today's market. In other markets, it might take 4 months to get to the next box. All right. So the times aren't even anymore, and the dollar amounts aren't even, but we're going to do this in a pyramid fashion. So between 40 and 50% down, you're going to deploy 3,000 as an example. And between 50 and 60% down somewhere, you're going to deploy 4,000. Now, this could be $1, $2, $3, $4. It could be, $10. It could be $100, $200, $300. The interval, the number, the zero after this number doesn't matter. All I want you to do is understand that what I do is increasingly pick up the number in the next zone. So I break the zone into 4 parts between 20 and 60 for Apple, as an example. I divide that zone into 4 parts, and I assign a dollar amount that I'm going to put in each one of those boxes. Top box, 1,000. Second, the box under the top box. Second box, 2,000. Third box, 3,000. Fourth box, 4,000.
All right, Oliver. Hey there.
Yeah.
So tech team has informed me that we are over time. So I was loving the presentation, but
no, you can't say I got to stop here. Really?
But that's what they're telling me. So but it's been awesome. I loved it. So all of our viewers loved it as well.
All right.
So we'll catch you next time, Oliver.
All right. Well, I'm here tomorrow. I want you to come tomorrow, and this is a presentation that I will finish on my YouTube channel. Boom.
All right.
See you tomorrow, guys. Ciao for now.
Well, thank you for the information, and thank you to our attendees.
Ciao.